Hello guys, welcome to my Investing for Beginners crash course. This is one of the most requested videos that I ever received from the day I started YouTube. So in this video, I'll discuss about what is investing, why we investing, about different asset classes, risk, style of investing. Also, I'll take an introductory look at financial analysis. We cannot learn everything overnight, so feel free to pause the video and watch the video in digestible amounts. So get your pen and your pencil. Also, if it's your first time on this channel, please like and subscribe. So welcome back to my Investing for Beginners crash course. So the first thing that I want us to understand today is what is investing. So some of us might know already, but before I can move on to a more intermediate or advanced course, I want us to understand what is investing. So investing in this definition that I use is the committing of money or capital to a venture with the expectation of making a profit. So the whole aim of investing is really to make a profit. Note brief, reading from the slide. The aim of investment is to grow your money over time. This can be achieved by starting your own business or investing your money in different types of financial instruments. For example, Jessica purchasing shares in Tesla, anticipating that future proceeds from the shares will justify both the time that her money is tied up as well as the risk of the investment. So investment is really to grow your money, and you're trying to get a return on your money. And you also bear in mind the opportunity cost. That's why I mentioned here for the time that your money is tied up. So that's one of the purpose of investment. But I'm gonna go into some reasons next, and I want to share about 8 reasons. So reason number 1 why we invest is to protect our purchasing power. So inflation is a thing here. The formal definition for inflation is the rise of the price of goods and services over a time period of about a year. So the rise of the price of goods and services. And if you can look at this diagram right here, this is the inflation chart for 13 years for Jamaica from 2009 to 2022 or 2021-22 year. As you can look at the bottom of this screen, you see a 6.6. So the average rate of inflation for Jamaica over these 12 years is about 6.6%. So every year, you can guarantee that at least the price of things gonna increase by at least 6%, 6.6%. So what happened now when you have your money sitting idle by not doing anything? It's really losing value because things are increasing. So if your money is not growing, it's really losing value over time. Right here, you can see I did a calculation of based on the rate in the previous screen, what would 100,000 be worth today? And 100,000 would be worth 43,566. So if you had left 100,000 in the bank back in 2009, today it would be worth 43,566. I mean, and the nominal value would still be 100,000, but really and truly, that's what the real value would be right now, comparing to the time in 2009. So, reason number 2 why we invest is to grow your capital. So, each of us have various goals and dreams, aspiration, and investing is just one way to just grow your money. Grow your money. God, your capital is basically the amount of wealth you possess. Number three, you use investing to achieve a financial goal. So investing can help you achieve bigger financial goals than you could otherwise afford, or it can help you to achieve those goals more quickly. Your financial goals might include buying your forever home, moving to an electric car instead of a petrol or diesel vehicle, setting up a college fund for your children, or arranging a reliable income for your retirement, separate from your pension. So you have to investing is a very personal thing, and you have to set it away. Or you work with a financial advisor, you can set up an investing strategy or program for you where you try to achieve a particular goal. Sometimes I mean choosing particular assets, which I will go into what are assets, or you choose a particular strategy, but you can use investing as a way to achieve your goals. If I want to travel to Dubai next year, maybe investing can help me to fund this trip. Number three, you earn more than a savings account. And as I mentioned about the inflation rate, that's one of the reasons. 5, you diversify your income. 6, you save for retirement. And 7, you help others achieve their goals, can be family or friends. And 8, you support other causes that are meaningful to you. So what are some of the most popular investments? So the most popular investment most people know is stocks, bonds, mutual funds, real estate, hedge fund, but not so much hedge fund, because hedge fund is really something that not everyone can, or not everyone is able to invest in. But I'm gonna get more into that as I go along. Unit trust, and you have exchange traded funds. So we'll get more into these as we go along. So the two main types of assets we have are we have real assets. These are assets that you use to produce goods and services, and you have financial assets. Real assets are things like your physical, like for example, let's say let's say I had a barber shop. That would be like real, and I have a particular clipper and a shear. Those things are like real asset. And let's say I'm a farmer and I have my oil, and I have all of those in a farm. Those are real assets. You're producing goods, and you can produce services. So anything that's physical and tangible, you can look at it as real asset. Financial assets now are claim on real assets, so are income generated by them. So things like stocks and bonds, these are financial assets. So stocks, as we will get more into that, is really part ownership in a company. So you will have a claim in this company, or the income generated, whether through dividends or preferred dividends, but it's really a claim. So I'm going to go into the various types of asset classes, and I'm going to walk through each option. From the left, we can see you have liquid funds, saving accounts, online wallets like Cash App, Venmo. You have in Jamaica, we have Link. You have hard cash, and this is physical cash. So cash represents liquidity and the power to buy anything. Moving across to the right, we have equity, startup fund. So equity is ownership in a sense. You could exchange words. You could really exchange words. So let's say I'm going to start a business tomorrow, but I don't have enough funds. Starting a new software company, and I want a web developer, but I don't have enough cash. I could talk to a web
design and say, I don't have the cash now, but I'll give you a percentage in my company. So that could be a way of I fund the business. So that's what we mean by equity. Index funds now. Index funds really are index funds are it's really like I would say you would have like a pool, it's like a pool funds, but they track a particular indices on the market. So you have the S&P 500, which is the 500 largest public traded company. You could buy into index fund that track these companies, and you have dividend companies. You could buy into index funds that track these companies. But in this particular case, it's companies that are more shares and stocks. So that's why I say equity. Then you have electronic traded funds, exchange traded funds, I should say, which mean we are normally interchange for ETFs. So these are likewise ETFs are funds also traded on the stock market, and these funds you have various types. Likewise, the index funds. So you have like S&P 500. You have the dividend ones. You have the pharmaceutical companies. But the good thing about ETFs is that you can buy them on the stock exchange. So if I want to buy a particular index, I can just sell it, but go on the stock market tomorrow and buy this particular index, this ETF that trade a particular stock. And the difference between the equity mutual fund, which is below, is that mutual funds are not really traded on the exchange, but mutual funds are really pool funds managed by professionals. So you can go into several companies, you can do it online also, and you can buy into various mutual funds that track particular asset class. In this case, it's equity. So it represent ownership into a business. So equity represent ownership into a business, and that's the essence of the asset class that I'm sharing in this section. Further to the right now, we have fixed income. You have endowment funds, um, endowment policies. This is like a type of investment you take out with the insurance, and you pay a particular amount of money each month or period of time. And this policy normally pays you a lump sum after a while, usually after 10 to 15 years or whatever time guaranteed upon. And or it can pay you a particular figure every month. Let's skip here too fast. No, we have debt mutual funds. So, at the bottom, you can see where you have fixed income represent lending money to someone. Yes, so debt fund, no, the debt mutual fund, which is the a fund that is with money pooled together that is managed by a professional. In a debt mutual fund, no, this mainly invests in like fixed income instruments. So you're gonna invest in things like bonds and also like preferred shares or treasury bills and those things that provide a fixed income every month. So this particular asset class track like trade it mainly pays out fixed income. Then further down now we have the debentures. So the debentures is like a type of bond that is unsecured by collateral. So the debentures normally are issued out by governments, or you have some corporations that issue debentures, but really the difference between a bond and a debenture mainly is that a debenture is unsecured. So why persons might give out their invest in this asset class? Let's say the government of Jamaica issue out a uh, particular bond. People will believe that the government have the ability to tax the citizens. So in any case, the government is one of the most reliable source because the government is the least likely to go bankrupt. They can increase tax, or in some cases, government can print money and do all of that. So EPF, no, PPF, and NSC. EPF, no, those are employee provident funds. So sometimes you hear persons talk about 401k and all of that. A provident fund is an investment fund that is voluntarily established by employee and employer and employees to serve as a long-term savings account. So in some companies, you will have a case where employees save a particular amount and the company say, I will back it or I'll match it. So let's say I save $1,000 every month. They will say I'll put another $1,000 on it every month. So when you retire now, you can collect this money is in either a lump sum or a monthly payment. So it's really a retirement fund, and it's taken from your it's normally deducted from your salary when you come to an agreement with the employer, and they will back it by the amount that you agreed upon with them. You have PPF, which is, that's also a public provident fund. Various governments have various forms of this, and you have national savings certificate. These are other fixed income instruments in other countries, in a lot of countries. In countries like India, in Jamaica, we have NIS. That is not exactly the same, but it's really the same principle. The NIS really is a security scheme. It's a compulsory scheme. Everyone who is employed is supposed to be paying NIS. Persons who work a 9 to 5 or with company, this is deducted automatically from your pay. So after a particular amount, or when you retire, after you reach a retirement age, you will be able to access certain types of grants and certain type of payouts, retirement payout. And if you're self-employed, you're supposed to be paying it by law. Bonds, no. Bonds, no, is really a loan to a company, and that's all the basic way to describe a bond. So a bond, no, is that, for example, no, so let's say a company, decide, let's say Apple want to raise money for a particular project, and they don't want to give out more equity. They can say we're going to issue a bond, and issuing a bond, no, me as a lender, no, they will have minimum requirements that you pay. So let's say I give them $100,000 through a broker, of course. When I give them $100,000 through a broker, there will be particular financial covenants that they must abide by, and they have agreements for interest rate, and bonds can be in various forms, but it's really a loan to either government or a corporate company. And they'll, at the end of the bond, what you call maturity, you'll receive back the principal. So if I lend them $100,000, I'll receive back the $100,000 after the end of the period. And bonds pay out interest. So you have the principal and the interest every month, or depends on what time period we agreed upon, quarterly or annually. They will pay me interest every month or every quarter or every year. So fixed deposit, no, is a tax-free savings account where you can save at the bank and you get a particular rate of interest depending on the amount that you deposit. I'm not going to go to recurring deposit and post office products. Those are not so common. Real estate, now to the right, you have REIT, which is Real Estate Investment Trust. And these are traded on the stock market. And buying a REIT, these companies invest primarily in real estate companies. These companies tend to pay out most of their income, And especially in the US, where by law they get certain benefits when they pay out up to 90%, I think, that the amount. And then real estate comes in various forms. As you can see below, it says real estate represents ownership of physical space. You have commercial property. I can build a mall or a plaza, and this can be my farm of real estate. I have bungalow, plots, I have flats. You can have apartments, all of this, and you can do Airbnb various ways. To the right, we have commodities. So you have gold, silver, copper, crude oil, wheat, and corn. Commodities represent ownership of goods which has an end use. So commodities are also traded on the stock market in various forms. Some of them is traded as futures. Not going to go into that, but that's one asset class. And oh, going back. Yeah, so commodities, and also you have instruments that you can buy on the stock market, where you buy, like, you have a claim to these commodities. So you can buy gold through through particular funds, in which these companies actually store the physical gold for you. So you have various firms investing in these asset classes. So stocks now. So this really is a mainly a stocks beginner course. What are stocks? Stocks are certificates of ownership in a public company. Stocks are traded on an exchange market. They reflect the market value of a company. Their prices increase and fluctuate on a daily basis. Stock prices can be found on an electronic strip called a ticker, and the symbol and letter represent the stock. So a quick way to look at it, stock really is ownership in a company, or claim to ownership. And one way you can look at it is that it's like a slice of a cake. So let's say I own 1 shares of of Meta, Facebook. I own a slice of the cake. I own one slice. So that's one way to look at stocks, like a slice of the cake. Types of stocks. So you have two types of stocks. So there have common stocks, usually entitles the owners to vote at shareholder meetings and receive dividends. And this is the most common, as you say, at the real estate common. What you normally find, these are popular on the stock exchange mainly. Preferred stock, no. These are less common, but you do not have a voting rights, but you have a higher claim on asset and earnings than common shareholders. And what we mean I have a higher claim is that, let's say the company went bankrupt, you would receive back your money, or your you receive back part of the company, or the payout over a common stock holder. So the common stock holder is taking more risk. But the bond holders normally come before the preferred stocks. Well, you see, some preferred stocks can also be converted to common share depending on the agreement at the time of the issue. But preferred stocks really pay out. The difference between a preferred stock is that normally you have payout, normally a payout per month or quarter, year. So it's really in some sense you can say it's a hybrid between a bond and a stock. Two basic ways where you make money from stocks are the capital gain. So when the price of the stock increase, that's the number one way how you make money from the stock. If I buy a share of Grace Kennedy, and the company move from $10 to $100, I gain $90. I gain on my money. So that's the way how you really make money on stocks. The first way, and then you have second way is dividends. So dividends is really a discretionary payout in the case of the common shareholder. Dividends are discretionary payouts, but a lot of companies pay out dividend is like a reward to the shareholders. So say, for owning this stock, we're going to pay you this money. And companies work to please their shareholders. So next point I must get to is that before the stock is listed on the company, we have what is called an IPO. So IPO and is really in long definition, initial public offering, and this refers to the process of offering shares of a private company to the public in a new stock issuance for the first time. An IPO allows a company to raise equity capital from public investors. So IPO is when the company is first listed on the stock market. So let's say I own a patty shop on the street, and I want to expand and get some stores, and I want funding. I could be that I want to have more branches now. I can go now and go to a particular broker, and we can work out some deal, and then we say, all right, I'm gonna I'm gonna issue shares in my company. I want to raise money to grow my company. Or either I could be raising money to pay off some debts. Or it could be that I have other investors in the company who want an exit strategy and putting the company on the public exchange, give other investors who are interested to get shares while that person can now sell out their shares. So you have APO also, which I didn't state on the slide. This is additional public offering. So from time to time, companies can go back to the market and say, we're going to offer more shares, we're going to raise more capital, we're going to do this with the money and blah, blah. And then they just have a APO, and that's one way how to raise money. So let's talk about historical performances of the stock market. So when I did a calculation, the stock market return since 1950, if you had invested $100 in the S&P 500, you would have $216,719 at the end of 2022. Assuming that we reinvested all dividends. So this return is about 11.12% per year. So what the point I'm making with this is that over time, the stock market normally increase cumulatively. So that's why I'm going to go into some strategies of investing that even persons who don't know much about investing and stock market can invest without knowing how to. So if you just left your money in the stock market and buy into the S&P 500 or the entire stock market, your money would have grown by 174 times in 50 years. So I want investors to understand that the market, as you can see on this chart, we have a thing we call market cycling, and I'm going to go into that also further along the video. But the stock market doesn't just go straight up. Sometimes you have bad times, you can lose money in the stock market. But overall, once you're patient and you know what you're doing, you can make money long term with the stock market. So let me share next clip with you. So this clip that you're seeing on the screen right now is a excerpt from the Jamaica Gleaner in January 4, 2002. And I looking at 4 companies that were on the stock market at that time, and they're still on the stock market. So you had Grace Kennedy, which was selling at $23. Grace Kennedy had several stock split, and stock split is when the company they like say they split the shares. So let's say they have 100 shares at a price of $1. They can now say we're gonna increase the amount of shares to 200 and split the amount per share to $0.5. Reasons why a lot of companies do this is like they want to increase liquidity and want investors to trade the stock more frequently. But Grace Kelly has several stock split, and the company is now at somewhere near I think $80-90 the last time I checked. But this would be a lot of that. This would be like I don't want to count in a wrong figure, but at least 20 time returns. Kingston Wharf, you see right here, is trading at the price of $1.22. $1.22. Kingston Wharf would have earned you at least 35 times return, and that's excluding dividends. So that was to show you the power of investing. This is just 22 years. So if you would just invest your money and leave it, you could make 35 times plus your money. Below we have NCB, and NCB, which was at the time of this excerpt, was trading at a price of $1.65. NCB is now at a price of $88. You would have received at least 53 times at this low rate, excluding dividends. And remember now, the NCBs are started at peak at $200 in 2019. So you could have at least made 121 times your money if you had sold at that time. So this is just to show you the power of how you can make money in investing. So earlier I mentioned about the S&P 500. You have the Dow Jones, you have the Nasdaq. So stock indices are a collection or basket of stocks of different companies. So really and truly, an index, yeah, it's a basket. So it's really a basket of stocks, and or it could be other financial instruments also, or derivatives. And indexes, normally you have various alternatives to how they can be managed. You have actively managed index fund, and you have passive forms. But S&P 500 is 500 largest publicly traded company. You have Dow Jones is 20 industrial companies. Or I think I could be off with the number on the Dow Jones, but it's somewhere there. So one thing, no, I think this is one of the most important part of this course. One of the market cycle. We have to understand about market cycle as investors. So the market doesn't always go up all the time. So we have to understand that you have 4 cycles in the market. You have accumulation, markup, distribution, and markdown. Cycles are prevalent in all aspects of life. So anything you look at in life, there's cycle about it. The stock market is no different. You will have bad times and you have good times, but you have to understand that it's really a cycle. Cycles have different period of time that they last. But what I wanted to understand about the cycle is that, or I'm going to go into each particular part, is that one of the problems is that most investors and traders fail to recognize these cycles and forget that they are cyclical. So once you have that in your mind, you won't really be too pessimistic if things are not going too good at times and the world market is plunging. First phase of the stock market is the accumulation phase. This phase is when the market has bottomed. So at the end, you can see markdown phase. To the left, you see accumulation. So Accumulation is when this market has bottom out, and it's like it's coming from the worst part of the market. So this phase occurs after the market has bottom, and innovators and insiders and few value investors. So you have early persons who buy based off value, and I'm going to go into that um more in the video. So we have personally called value investors that buy based off just the value, the intrinsic value of the company, what the cash the company is produced. So these are the persons who start to buy at the beginning of the cycle. At this phase, valuations are very attractive, and the general market is bearish. So we are in a negative period time now. We could be between the markdown or the accumulation. In this time, the media is preaching gloom and doom, and we're at the worst of a bear market, which a bear market is like a general time of decline and pessimism in the stock market. Normally, you have more than 20% decline in the whole stock market. However, at this particular period, when prices flat, you have a lot of first innovator investors start to buy the stocks. Now, after they start to buy the stocks, the market start to become more stable, and the early and then you have some more people now start to go on the bandwagon, and more person and more people start to buy more stock. The media begin to discuss about like the possibility of the whole bear market over, recession over, and people start to jump back into the stock market, and everything is starting to getting better right now. At this phase, the negative part of the market is becoming is coming to an end. Finish. And at this particular time now, everything start to go up, and then investors are in, and everybody is starting to make money in the stock market. Then the third phase now is the distribution phase. In the third phase, the part of the cycle, this is a part of the cycle in which bullish sentiment it started to turn now. So you remember the previous section I mentioned in that everything is getting positive now. The distribution phase now is you have a mixture of bullish sentiment and bearish. So bullish sentiment is when you have general positivity in the whole market, an increase of more than 20% and all of that. So, but now at this distribution phase, it's a mixture of both negative and positive. The fourth phase, which is the hardest phase as an investor, is the markdown. And in this phase, the stock market crash. But a lot of persons hang on to their investments because it fall below what they buy it. And that is good in a lot of, in some cases, the best thing is to hold on because the market cycle won't last forever. Other phases, if you didn't buy and value, it could be a time to sell. But in general, this is a negative time in the market. Unfortunately, this markdown section normally lead to a buy signal for like early innovator investors. But it is toughest time in the market to buy stocks because prices sometimes are falling or are very low, stable, and the market is negative, but a lot of wealth is created in the markdown section. So you have to understand this. The role of information in the financial market. So stock prices reflect investors' collective assessment of a firm's current performance and future prospects. So when the market is more optimistic about the firm, its share price will rise. At the higher price, fewer shares must be issued to raise funds necessary to finance a prospective project. For example, a research and development effort or expansion of operations. All stocks are regarded by investors. Stock prices are influenced by activities of the company. So you have to understand that things like announcements that involve the company and changes in the industry can influence the stock prices. And it's part of what we call fundamental analysis. So if any these activities, sometimes you hear a big announcement that revenue will fall a certain amount and you see the stock price, there's a sell-off. These things influence the stock price. Sometimes the market overreact and sometimes the market underreact. When selecting stocks to purchase, an investor might put their money towards stock as well as well-established companies. These are known as blue chip companies. So you have certain companies that pay out regular dividend, they are mature. These are what we call blue chip companies. Earlier I mentioned about bull market. So the formal definition would be is a bull market is a condition of a financial market in which prices are rising or expected to rise. Bull market is characterized by optimism, investor confidence, and expectations of strong results. So this is a bull market. Right now we're in a bear market, which I'm going to show next. So a bear market is when there is a prolonged period of price decline. Normally, it's a time of widespread pessimism and negative investor sentiment. Stock prices tend to fall more than 20%, at least more for the major indices that I mentioned. So what is risk? Risk is defined in financial terms as a chance that an outcome or investment actual gains will differ from an expected outcome or return. Risks include the possibility of losing some or all of an original investment. So we have to understand that in the investment is a thing where we can lose money also, not just gain. But one thing I always say to most investors are new investors, invest what you are able to lose. So you must always have an emergency fund, and then you can invest what you're able to lose. Or also it could be also you invest based off your risk appetite, which I'm going to get into soon. Financial markets. All right, so allocation of risk. Virtually all real assets involve some risk. When Toyota built its auto plant, for example, it cannot know for sure what cash flows those plants will generate. So sometimes we can make models and predict, but sometimes you just don't know until it happens. Financial market and the diverse financial instruments traded in those markets allow investors with the greatest taste for risk to bear that risk, while others, less risk tolerant individuals, can to a greater extent stay on the sideline. So if you are not able to stomach the risk, sometimes it might be that you take less risk or you avoid investing. Unfortunately, you have to take the risk if you want to gain. So this is an example of asset allocation. Asset allocation depends. So all right, so I want to understand that various asset classes tend to perform differently under different market conditions. So and some, like for example bonds pay fixed income. Stocks, sometimes you have to wait a while before price actually actualize to its truly worth. Cash is always safe. Well, not necessarily safe because you're still losing value if you're not investing, but you have access and you're not losing, you're not just going to lose the value. like a stock market. No, you don't gonna just lose it and you have to wait a while for that cash you have. It's more liquid. So when you're really investing, you have to understand the type of asset you're investing in. Stocks pay out dividends and you have capital gain. Sometimes this can take years for all of this to happen. 1 or 2 years, sometimes 6 months, sometimes 10 years. Bonds on the other and no pay out a fixed interest quarterly or monthly, and you get back your principal, but it tend to don't perform as well as stocks in the long term, but it's generally regarded as being more safe. So depending on your age, a 65-year-old could probably choose a conservative section, so they could invest less in stocks. Because let's say you retire at 65 and you just retire, maybe it would be best for you to take on less risk with the stock, invest more in the bonds to get the more fixed income, and you don't want to risk losing that over the long term. Moderately conservative, no. So this they also depending on your goals and your timeline and all of that. Aggressive at the bottom now. You see 80% stocks, 15% bonds, 5% cash. This can be a young person who's 20 who just begin to invest and they don't have much to lose, but they want to gain a lot. So they invest more aggressively to gain more, because stocks normally outperform bonds over the long term. So the more time you have, the more risk you could potentially take on. So I'm going to talk about 5 investing styles. So yeah, value investing, which is when you invest based off intrinsic value. So you invest, let's say I am evaluating this company, and after checking out the cash that this company will produce in the next 5 years, I realized this company will pay me out $500 in cash. But the company on the stock market is selling for $300. That obviously would be a buy for me because I'm getting a discount on my money. That's essentially what is value investing. So you buy based off the intrinsic value, the cash that the company is producing. All right, yeah. Or it could be based on value investing too. I could reject stocks based off this. So this same company that I've just paid $300 for, but I see it's worth 500. Suppose it's trading for $1,000. No, I could look at the value now and say this is not worth it and I'm not going to buy this based off the value investing principle. Growth and investing no is when you invest mainly just for growing stocks. Stocks that are growing at over more than 20% are growing very fast. And that's the main feature of the growth investing strategy. You're investing in growth companies, startups, or companies that's just listed and they have a lot of potential. This can be profitable as well. And value investing can be growth investing as well. But growth investing doesn't necessarily have to be value investing. Third, we have information traders. These are persons who normally just mainly speculate. So they hear an announcement or they hear some news and they just buy. They just want to hear one news or some story and they don't do any form of fundamental analysis. They just buy the stock. They just trade based off information. Yes, essentially all investors trade off information, but these investors are mainly speculators. They don't do any deep dive into the company. Why is this so? And companies can deviate from time to time, can deviate from their true value temporarily. Buy and hold investors. So these investors, they just buy companies and hold them over the long term. And this can be profitable as well. If you're not an average sophisticated investor, you can buy and hold good companies, maybe with the help of a financial advisor or person knowledgeable in the stock market. Now we have index investing. Now when you buy based off the basket of stocks that I mentioned previously. So you have, let's say I like one of the stocks that I own is the Vanguard for VOO. This is a this is really a ETF, but it really track the 500 largest publicly traded companies. So over time, the S&P 500 increased significantly in the market. So if you're not a really sophisticated investor, you can just buy index or ETFs and that track particular stocks that are companies that suit your goal. So instead of doing research into a lot of companies, just buy some index or buy some ETFs. You don't have to really be a complicated investor. Things to consider before you buy stocks. You have time horizon, risk tolerance, goals, and the fundamentals. Stock analysis now. So this is the last section that I will be going into. So we have 4 sections I want to talk about quickly. Financial statement analysis, ratios analysis, qualitative analysis, and types of valuations. So firstly, I'm going to look into the financial statements. So we have 3 financial statements. I'm going to look into the first one, the 3 major. The first one is income statement, and an income statement shows a company's revenue, expenses, and profitability over time. And it's sometimes called a profit and loss statement or earnings statement. So here's an example. So at the top, we see we have the revenue, the total revenue, and the company have 2 sources of revenue, revenue from trading and merchandise sale. And then at the below, you have expenses, procurement costs, wages, rent, interest paid, transportation, utilities, and total expenses. So our income statement really is, you really take away the expenses from the revenue to get the net income. But before we get to the net income, we have gains. So let's say we see I have gains right here. Let's say I have a van in the company that do my transportation. The van was valued at $4,000, but I sold it for $6,000. That means I gain on the van. So they would include this in the income statement. And similarly, anything that causes you to lose money, different from the value, different from the book value, or anything otherwise from the business, the core business, they call it losses. So let's say I have a factory in a company in a next country, and the factory was forced to be closed. And then that would have to fall under the losses. But in this example, we have settlement costs of consumer lawsuit, and in a lawsuit where the companies now have to pay out money, that would fall under losses. And the revenue take away expenses. So revenue plus the gains take away expenses plus the losses, and that would give you net income. The balance sheet. What is a balance sheet? The balance sheet refers to a financial statement that report the company's assets, liabilities, and shareholders' equity at a specific point in time. So the balance sheet tell you about the asset, liabilities, and equity, which is the ownership in the company. And you can see liabilities plus equity equal to the assets. Those are the resources of the company. And the liabilities and equity, these make up the sources of finance for the company. So in most balance sheets, you have roughly about 5 main sections. So you have our 3 main sections. You have asset, liabilities, and equity, but you have subsections. So under assets, you have current assets and non-current assets. Current assets are those that are more liquid, like cash, marketable securities, inventories. I have non-current assets such as property and plant. Also, you have liabilities, which are like sometimes things owed to other companies, like for example, accounts payable. It can be also responsibilities of the company, or or deferred revenue, which is like revenue you might receive for work you haven't really completed yet. Let's say I have a subscription at Apple for 1 year, and they collect for the whole entire year, but I only get 2 months out of the service. That would be counted as deferred revenue. That's a current liability. So the more liquid liabilities, which are due near in time, those are current liabilities. Now you have non-current liabilities, and you have like term debt, like bonds and those things. Those can fall under long-term liabilities, like the principal of the long-term of the bond could fall under non-current liability. Then you have shareholders' equity, common stocks, an additional paid in capital, and you have retained earnings, which is the money that the company retain that they haven't paid out in dividend, or they retain that which is really owed to the equity holders in the company. So these sections make up the balance sheet. The third statement is a cash flow statement, and the cash flow statement provides aggregate data regarding cash inflows into the company and outgoing cash, its outgoing operation. Or I'm gonna give the formal definition. A cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receive from its ongoing operations and external investment sources. It also includes all cash outflow that the company for the business activities and investment during a given period. So a cash flow statement really is to explain the changes in cash. So it tell you about the cash that come inflow into the company and the cash that goes out. And the cash flow really tell you how much money the company really make. Cause earnings on the income statement can be non-cash. So you can have a company that state 400% increase in earnings, but only 100%, but only 25% is cash. And that can be problematic. And that also can show the quality of the earning. So those things, you have to bear those things in mind. You have quality of earnings from the income statement. So this is an example. With our cash flow statements, you have three main sections. You have this, and then you have the finance section. So you have cash flows from operation. That is the money that the company make from the core business. You have cash flow from investing. So these are things the company is investing to grow the business, equipment, and so on. And you have cash flow from financing. So the company can receive money to fund projects and all of that, like bonds, notes payable, or the company might pay out dividend and all of those things. So those things fall under financing, and the cash flow will gonna tell you, at the end of the day, gonna tell you the amount of cash the company receive with the difference between the two different years. So at the end of the year, so the company gonna have a beginning balance and an ending balance, and they're gonna know you if the company has received less or more cash. And the cash flow is very important in regards like to a value investor, to what I would say one of my favorite metrics normally incorporate things from the cash flow, the price of free cash flow. But we're going to go into that in the next section. Next section is ratio analysis. So the ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements, such as the balance sheet and income statement. So you have 6 main ratios that I place on this presentation. So you have the 6 various types of ratios that I'm putting today is we have liquidity ratios, solvency ratios, profitability ratios, efficiency ratios, coverage ratios, and market prospect ratios, which sometimes we call valuation ratios. So liquidity ratios explain measures the company ability to pay off its short-term debt, like current ratio, quick ratio. And it just try to check the company ability to meet its short-term debts and obligations. Then you have solvency ratios. This company compare the company debt level with its assets. And these ratios evaluate the likelihood of a company staying afloat over the long haul by paying off its long-term debt, as well as as well as the interest on its debt. And common example include debt to equity ratios, debt to asset, interest coverage ratios. You have profitability ratios. These tell how well a company can generate profits from its operation. And these include like return on assets, return on equity, return on capital employed, and all of that. Efficiency ratios evaluate how well a company uses its asset and liability to generate sales and make profit. And you have like turnover ratio, inventory turnover, and these sales in inventory. You can always make a quick Google on these types of ratios. Coverage ratios measure the company's ability to pay the interest payments and other obligations associated with its debt. Examples include times interest earned and ratios and the debt service coverage ratios. So these ratios estimate the ability to pay, like cover your interest payments and all of that. I have market prospect ratios. These ratios like give you like help you to try give a predict the earnings and the future performance of the company. You have price of earnings ratio, the PE, you have earnings per share, you have dividend payout, and you have price of free cash flow. I'm going to share this example. I'm going to share the example of it. So you have qualitative, instead I'm going to talk about the qualitative analysis. So when it comes to a company, evaluating a stock, you have two types of analysis. I have dived a while ago into the quantitative aspect, but you have the qualitative aspect of evaluating a stock. So the management quality, the board of directors, competition, and the industry. One common tool that any investor could use is the Porter's 5 forces, which looks at 5 forces that most companies face. So you have competition in the industry, potential of new entrants into the industry, power of the suppliers, power of customers, and the threat of substitute products. So those are 5 forces that a person will have to that can use to evaluate a company. So the Porter 5 forces model help you to identify and analyze all of these forces. And you can use it to identify the company corporate strategy. So in terms of valuation now, so you have 2 types of valuations. You have relative valuation. So here I mentioned that about valuation. There are 2 types of valuation. You have relative valuations and you have absolute valuation. So absolute valuation is when you look at discounted cash flow, dividend discount model, and all of that. So this is when you look at just the amount of cash the company is producing and paying out over time, and they use this cash to estimate a value. Now we have relative valuation where you can use ratios and you can use trends of the companies, whether past or over a number of years. You have common size financial statements, which is you comparing so common size financial statement is like it as a word to call common size. So like say I have a $100 billion company and a $10 billion company or $100 million company. I can compare these two companies by just like put the various aspect of the financial statement like as a percentage of revenue. So it's really comparing the company against itself and the efficiency. So in a way itself, it like can level the playing field. So not because this company is worth 100 billion and this is worth $10 million. No, with a common size and you measuring this particular company as a particular against its particular revenue, no, you can see how efficient this company is. So that way, you can understand which company is performing better, not without have to worry about the size. And then you also can compare against various time period. No, the example that I mentioned, I'm gonna share. I want to get back to it. So stop. Mm. So as you can see right here, these are some of the ratios that like this is a website that I use to analyze some companies. Yeah, financial ratio history, yeah, financial position, some of the ratios, quick ratio, current ratio, yeah, financial efficiency, a return on asset, return on equity, and all of that. And then you have the valuation ratio, which is the market prospect ratio that I mentioned about. So you have the PE ratio, which is the amount of time the company is trading against its earnings. So this company is trading at 45 times its earning, which is look at the company here, Nvidia. And yeah, forward PE, which is normal an estimate by the analysts, normally based off their expectation of income growth. Now you have price to sales, price to book, peg ratio, and you have price to free cash flow, which is one of my favorite because you're looking at the cash that the company is produced. Um, and you can compare it with other companies in the same segment. So, and as I mentioned before, you have tools you can use to help you in various aspects. So the balance sheet right here, this also shows you uh, various various aspects of the balance sheet, the book value, net cash, and all of that. I have videos on, if you make it this far, I want to know that I have videos on how to invest in the US market and the Jamaican market. So if you make it this far, share, like, and subscribe. Thanks for staying. See you in the next video.